think we got to start with WeWork. Every day there's more headlines around WeWork. Now we're getting changes, governance changes. I can't help but wonder, given the fact that there's so many red flags around the governance as it was first presented, why those changes are happening now, why they didn't happen before that first prospectus was dropped.
I mean, the easy answer is that this is Silicon Valley hubris, that this was the epitome of the founder who wanted total, complete control for life, ceding nothing to shareholders and guarantee nothing about the future of the company. And that's what the S1 that WeWork initially filed read like. Well, it turns out that investors are not on board from that, and the valuation that WeWork is potentially getting, they're hearing from investors, is a lot lower than the $47 billion valuation that SoftBank was willing to pay all along.
Casey, you're based out in Silicon Valley. What is the sense, given everything that we're seeing play out here with WeWork ahead of this roadshow that's expected next week? I mean, is it seen as sort of a tipping point in terms of what can be asked of the public market?
Yeah, I mean, Morgan, to me, this is just the most entertaining IPO story of the year. You know, everyone wants to call a Silicon Valley story. This is a New York company. This one is on y'all, right? And it's also a company that's totally in panic mode, right? And every day now they're trying to come up with something to salvage this IPO, and I don't know if they're going to do it.
Yeah, we got to own this one, Kevin. And this does not look to me like a humbled company. Yeah. I mean, before, the first version was control beyond life. Yeah. The kind of revised government is just control for life. Yeah. And maybe, you know, a less of an iron grip on control, but still kind of iron. I mean, this is not a humbled WeWork here, the way I read it.
No, I would make exactly that point. And I think the other thing, investors should think about a few other things. And the primary two are the disclosures that are being made. In the S1, this business is a really opaque business. It's transactions with counterparties, with other divisions of the company. It's very highly leveraged, and I think it's really hard for investors to get their head around it, given the amount that WeWork has disclosed, putting aside the Adam Neumann issues. The other question is valuation. So there is speculation that they could go public, $30 billion or more. As I said before, SoftBank paid at a valuation of $47 billion. All of the other investors in private transactions seem to think that this company is worth $20 billion. If you look at the history of transactions, putting SoftBank aside, WeWork needs this transaction because they need money, but it's very reasonable to think that that's closer where this IPO price is.
What do you think SoftBank does here?
I don't know. It feels like a game of chicken. I think, WeWork was pushing for this IPO. They've been trying to get SoftBank to actually effectively buy them out this year. SoftBank was far down that road and then kind of backed out because of some concerns about it. And so I think the IPO goes forward. I mean, the fact is that WeWork is a business that needs access to cash. There's $3 billion they want to raise in this IPO, and another $6 billion roughly in loans and credit that is linked to a successful IPO. It's hard to see, if SoftBank's not willing to put up those $9 billion, it's hard to see WeWork backing off of this.
At what point do we start wondering how much equity SoftBank has in this period? Yeah. I mean,
no, I think it's a question for SoftBank, and are they willing to write down the value of their investments? They're already, with Uber, they're underwater. It's for those who were skeptical about some of the valuations, the euphoria around free money in Silicon Valley over the last year or two, which SoftBank is at the center at. We're actually seeing that story play out in a way that is not positive for SoftBank.
Casey, we're awaiting the first trades of CloudFlare as that company looks to go public here at the New York Stock Exchange today. It is a legit tech company that is going public, right? It's a company that helps websites protect and distribute content. That said, quite a number of the IPOs we've seen either come to market already or are currently in the pipeline may not be traditional tech companies, but certainly have sought the perception and really emphasized the role technology is playing in their business models. Is it warranted?
Yeah, look, this is a company that has solid bones. It provides a real service. On the internet today, any number of web-based services could find themselves under attack at any time for any reason. All of them are going to invest in the kind of security that CloudFlare provides, and to date we haven't seen CloudFlare do some of the creative accounting that some of these other really terrible IPOs have done. They've grown a little bit more slowly. They've been a little bit more prudent. So I think if you're an investor who wants to get a piece of the tech market with a company that's been relatively responsible in how it's grown, I think you're probably going to want to give CloudFlare a good look.
And Casey, this is the type of company that Wall Street has kind of liked this year. I mean, for all the drama around Lyft, around Uber, Smile Direct, I mean, the stock is kind of shaped like a smile so far. We'll see if it's a crooked smile or not. The IPOs overall have done pretty well, really well this year, and this is the type of company, despite the fact that it's not profitable, that people have sort of embraced.
Yeah, I think that that's exactly right. There's a lot of reasons to believe that Cloudflare can become profitable because it doesn't have to, invest tens of billions of dollars in finding its market, right? It builds a good service today, and now it has to figure out how to get that service into the hands of more customers and, sort of increase its profitability. So I can at least see a clear path there for Cloudflare where I can't see it for some of these other IPOs.
Kevin, quickly.
Yeah, and John, I think what you're referring to is Zoom is one of the companies, the video conference company, which was profitable, went public, the market liked it. It's worth noting that the company that the market really liked was Beyond Meat, which was the company that was not in the tech business at all. And
Agritech.
So we're looking at a constrained set of companies, but actually looking outside of them, you're seeing companies that investors are even more eager for.
You're making it sound like we've tested investors' limits on business models, on opacity, on governance, on ownership structures, right?
On valuation. I think that's totally fair. We've had what these effectively are for a lot of these companies are down rounds. They raise money in the private markets. They've stayed private longer than companies traditionally, and they had a big pool of cash sloshing around that gave them very rich valuations. These IPOs are down rounds for these companies and probably reflect the reality better than what the private investors are willing to pay.